In this video, I will make an attempt to explain what financial statements are through an example. What we'll do is we'll take a business, a simple business for that matter, and start it from scratch, and in the process understand how the financial statements for that business will look like. Let's get started. So you are a corporate employee and you have been working in a corporate world for a couple of years. You are bored with your life and you always think about starting your own business someday, but you don't know which business to start. Then you realize that, hey, I always drink coffee or tea at Ramesh Bhai, and Ramesh Bhai being a good friend of mine, he has shared ins and outs about tea business with me. So for starters, why not I should start a tea business? An idea gets to your mind, I want to start a tea business. Now that you know everything about the tea business, you start thinking about how to start it. First question which comes to your mind is, what all things are required to start a tea shop? The first is stove to boil the tea. Second are utensils to hold and distribute the tea. Then there are ingredients like milk, sugar, tea powder. Then you also need a shop, but in this case you will take a shop on rent to run the business. And then you realize, hey, I also need a capital to make all these purchases, and you figure that you will need rupees 50,000 to start this business. First you need to arrange the capital. So there are two ways to arrange the capital. One is you can put your own money, or you can borrow money from a bank. You decided to put 25,000 and then you borrowed 25,000 from a bank. Thus you arranged a total capital of 50,000. Now the capital part is taken care of. You go to shop to make the purchases. First you buy a stove of worth 20,000 rupees. Then you buy utensils for another 10,000 rupees. Then you purchase ingredients of 5,000 rupees. Thus you spend total 35,000 making these purchases. Once the purchases are in place, you start thinking about a shop. Then you realize that you have a friend who already has a tea shop, but that shop is not operational. You call him and then you are in a luck. The friend says, hey, you can have my shop, the furniture and everything is ready. All you have to do is come here, set it up and run the show. You agree to the terms. The friend says you'll have to pay 6,000 rupees as a rent. The rent has to be paid at the end of the month and there are no deposits. It's a good deal for you and you take it. Now that we have arranged basic elements of the business, let's take a step back and understand our first financial statement, that's a balance sheet. So what is a balance sheet? To put it in a technical term, balance sheet is a statement which summarizes financial position of the company at a specific point in time. So balance sheet is divided into two parts. The first part is assets. Assets are the things owned by the company. Examples are stove, utensils, etc. And the second part is liabilities and equity. These are the things owed by the company. Examples are bank loan, payables, etc. Notice two words here, owed and another is owned. So basically, whenever you are thinking about a balance sheet, always think it from the point of view of a business. So let's say assets are the things owned by the company. Business owns these assets. And liabilities are things owed by the business. Business owes these assets. And there's a golden rule of a balance sheet where assets will always be equal to liabilities and equity. Please do not forget this golden rule. Now, the assets are further divided into two parts. The first is current assets. These are the assets whose economic life is less than a year. Examples are receivables, inventory. And then there are non-current assets whose economic life is more than a year. Examples, stove, utensils, etc. Similarly, liabilities and equity section is divided into three parts. Current liabilities, as you would have guessed, they have economic life less than a year. Non-current liabilities, they have an economic life more than a year. Examples are debt. And then there is a third section called equity. And this is nothing but shareholders' stake in the company. So typical example is common stock. And this is how typical balance sheet looks like. So if you observe, there are two parts, assets, and there is a liability and equity. Assets is further divided into current assets and fixed or non-current assets, and then there is a further breakdown. Similarly, liabilities and equity section is divided into current liabilities, non-current liabilities and equity, and then there is a further breakdown. Now that you have a basic understanding of the balance sheet, let's go back to the business and let's construct our day zero balance sheet. Let's revisit our step 1. In this case, let's think from the point of business. Business arranged money from the owner, in this case which is you, and the bank. Business took 25,000 from the owner. Let's label it as a common equity, and the business took 25,000 from a bank. Let's label it as a debt. As a result, business has 50,000 rupees in the cash. And if we put these transactions into a form of balance sheet, this is how it will look. So on the liability side, we will have a bank loan of 25,000 rupees, owner's money of 25,000, thus total liabilities and equities is equal to 50,000. On the asset sides, let's say we did not make any purchases so far, so we'll have a cash of 50,000, which is an asset, thus total assets is 50,000. If you notice, total assets will be equal to total liabilities and equity. If you go back to a step 2 where you made purchases, you made purchases of total 35,000. You converted the money into your assets. So 20,000 money was converted to a store, 10,000 rupees were converted to utensils, 5,000 were converted to ingredients, and thus you spent 35,000. We'll label the store and the utensils as a fixed assets because we expect them to have an economic life more than a year. We'll label milk and sugar as a inventory and we'll put it under current assets because we expect it to have an economic life less than a year. And if you put these transactions in a balance sheet again, so you will see that now the cash was converted to ingredients, utensils and store, but the total worth of all these assets is still 50,000. There's no change on the liability and equity side. If we reconstruct this balance sheet into a standard format, this is how it will look. We'll put cash and inventory below the current sections. We'll put utensils and store below the fixed or non-current assets. We'll put debt under non-current liabilities and we'll put owner's money under equity. There's no change in the balance sheet. All we did was repurpose it. And this is how our day zero balance sheet will look like. This was the only first video where I wanted to explain the day zero balance sheet. In the next videos, I will also explain the day zero cash flow statement and day zero profit and loss statement. Thank you.